Welcome to Lithium-Ion Rocks. It's March 23rd, and we are here with Season 1, Episode 6, Respect James Brown, AJM, and Chuck Berry's Back to the Future, PLL, Piedmont Lithium, and also IoNeeR. Growing up, I was a big fan of The Jetsons, a show from the late 1960s, a time when the United States was producing nearly 100% of the world's lithium. From this episode onwards, I'm going to start talking about Jane and George battery pack instead of Jane and Joe. And we'll also draw a parallel to another favorite, the Flintstones, where Fred Flintstone worked in a quarry, similar to a hard rock lithium mine. I see a future where the United States has leadership both in electric vehicle production, but also hard rock lithium mining and chemical processing. So I think we're going to go back to the future. Lithium-fueled electric cars, flying cars, from made in the USA, lithium-rich hard rock.
It's great to visit Piedmont and see, the home of lithium has been in the USA. I was very impressed. It was good to meet the team and see the core shack. I thought that the management team is good, but a special shout out to Patrick Brindle, who I thought had an excellent understanding and handle on the project as a whole. For my mind, I like what I saw, and I'll be writing up on that in the near future and publishing an open note. With IoNeeR, of course, you joined me there. I had originally had limited knowledge of the project. It had run up hard. It touched a 600 million market cap at one point, which seemed high for anything that was still in the exploration development phase. But now, having visited the site again and seeing the material that they're working with and the chemistry and how well that material is likely to leach, it's another project that I was impressed with. What did you think?
Well, I'd been to Piedmont a number of times, so I'm glad to hear an independent assessment that reaffirming the quality of that project and the management team. IoNeeR, I was very impressed with. First and foremost, it's a boron project, and the boron market dynamics I was not super aware of, but the more I've researched it, I see it's essentially a duopoly with Rio Tinto and the Turkish government and a few mines there. And the Rio Tinto mine in California seems to only have a 10-year mine life. It's not particularly low cost anymore. So from a offtake partner, I've been very focused on lithium offtakes, but consumers of lithium are also consumers of boron. And whereas lithium off-takers have any number of projects that they're in dialogue with lithium developers for. In the boron space, it's much more limited. And so I see there's a very good potential opportunity for IoNeeR to secure boron offtake to help finance the project, which is, according to them, I think 40% boron and 60% lithium revenue based on relatively conservative estimates. But I was impressed by your analysis of the deposit and how it differs from traditional clay. IoNeeR has often been put in this kind of not brine, not hard rock, but the other category. The other category is often not properly analyzed, but it very much is not a clay. It's a searlesite, and I remember when Bernard showing us taking, and actually they have a fair bit of clay, which they're stockpiling, but it's more their searlesite, which is closer to hard rock. And he gave an example where he put the searlesite in water and he put the clay in water. The clay dissolved and the hard rock did not dissolve. And that is key and a differentiator to their project, in that once it's dissolved in clay, it's very hard to separate the material, the lithium and the boron, from that liquid, whereas the leaching process, as you articulated, of the harder rock is a more plain vanilla, traditional, been done before process.
Yeah, I think that's a good overview, and I think having been to the project, I'd say that the things to watch now is less so in terms of the chemistry and the processing and in the permitting, and now more a question of securing offtake or, securing the necessary funding, because it is going to require a fairly substantial amount of capex. But again, if you look at the board, Alan Davies and some of the others, long history in boron, very experienced, ex-Rio. So, yeah, I definitely came away with a good view, as I did with Piedmont. So, nice to see two projects in America that a country with very limited supply, with hope out there to change that in the future.
What did you think about the, business, regulatory, tax environment of the U.S. versus some other jurisdictions?
Yeah, we had that discussion. If you compare it to something like Argentina, where in certain provinces they have free carry, where there's an export tax and then a 35% income tax, a lot of people assess these projects on their technical merits and on their EBITDA, but actually one should really look ultimately at after-tax cash flow, free cash flow. And in the States, for example, with Piedmont, there's no royalties. There's certainly no free carries. You've got a federal tax at about 21% and then a state tax, I think, at 2%. But then there is a depletion allowance that's allowed on resources that takes their effective tax rate back down to around 15%. So on an apples to apples versus 35% in Argentina plus the export tax, et cetera, there's a big difference. And I think once these projects, if they go into production, that becomes a very relevant factor in terms of genuine after-tax cash flow. So
that's what ultimately pays dividends. EBITDA doesn't pay dividends. To be continued. Look forward very much, Rodney, to your, written analysis. Would invite all listeners here we're going to give a little bit of an advertisement for the LithiumIonRocks, Lithium-ion Bull, RK Equity, Rodney Hooper. We, in addition to putting out a lot of this free information, do have a regular business of advisory analysis. Started to do a couple of expert calls with hedge funds who are telling us they're very much interested in hearing different voices. And the work that we've put in the public domain has garnered that. So anyone out there listening, we're very easily accessible on LinkedIn. Please feel free to reach out to Rodney or me, and we can have direct dialogue. We have James Brown from Altura Mining with us. Very proud to have James here, having just announced a second upsize to his SPP plan. They started at 5, went to 10, and now $14 million, and also declared commercial production after earlier this year having had a shortfall in financing due to some small production hiccup, which James, you can explain. But I think you raised $23 million in the institutional tranche, and you went out for $28 million. So there was a shortfall there, but a big uptick in the SPP. So what happened that there was the shortfall in the institutional tranche and such a big uptake from your existing shareholders?
Thanks, Howard, and thanks for having me on the podcast. I think probably break it into two facets there. We were looking at, obviously, additional gap funding as we push through the ramp-up, which has been very successful, but obviously we'll put again the reasons in regards to cargoes and shipments that push you in these positions. But we had a medium-sized ability to look at how much we're going to raise, and we were looking at around $28 million in total, and we included what we thought was a fair way for our participants, our shareholders, and have been very loyal to engage with us and have the same deals. So we set aside $5 million of that. So we we really looked at the 23 to 24, which was the target, and hopefully capping the 30 million range, inclusive of the full take up of the 5 million of the STP. So we had hoped that would be well received. It was, but in like anything, often people will wait until the latter part of the event in order to commit to what's happening. And there's obviously a lot of ups and downs in the markets as we go through the ramp up, and certainly the lithium industry in the whole is subject to the highs and lows of thoughts at the general time. So we're able to get a feel only last week as to where the STP sat. It became very evident that we needed to raise it. We were considering maybe going to 7 million from where they were sitting above the 5. In the ensuing couple of days, it became evident that 10 would be required to fit everyone under the umbrella, and as soon as we made that call, immediately after that, it looked like 14 was a reasonable amount, which we chose to cap it at, which is the limit of our placement of shares at the moment.
I recall, James, in October 2017, I was involved with you in raising the full funding, 28 million equity placement, which was done at 19 cents. And here you are raising money at 13 cents with a half warrant. At 20 cents, using Black-Scholes, it's equivalent of a 10-cent issue, 50%, approximately down from 15 months ago in an environment where the need for your product is even greater than it was then. And again, that October 2017 issue, those investors who came into the placement doubled their money within about 4 months. If I did the math, I think it was about $45 million US in total that you had an overrun compared to your definitive feasibility study. What happened there? I know you brought in Primero, but if you could just summarize briefly what happened and where you are today and what we should expect over the next couple of quarters.
Yeah, Howard, I think the numbers you included, I wouldn't consider them the overrun numbers. Obviously, the numbers closer probably to 20 over the $170 million build. There's a lot of variance in that, and I think one of the things, if you look at it historically, we were commencing construction, and I think as you alluded, you were well involved in assisting us with our funding package. Was the fact that we commenced construction with a partially complete funding package. We had equity from one of our partners. We'd raised some additional cash before that in 2016. So we were looking at somewhere around the $60 million cash commitment to commence the mining process and also the construction of the plant at Pilbara in 2017. So in order to maintain momentum, we decided we would commit to that whilst we sought the remainder of the funding package, which left us with the debt package, the component of the original $110 million US through our 3 loan note holders. In essence, because of the way the package was funded, we weren't able to fully have an EPCM, let's say, for the entire project. So in order to keep momentum moving, we had to break the packages down into smaller packages and manage that through both ourselves and supplementary technical groups moving forward. So, in essence, when you look at the project as it moved along very closely and very adherent to the plan that we'd set. It wasn't evident until May and June last year that some of the items and some of the more technical items, including the electrical, were taking far longer to complete, and we'd already committed to a plan to accelerate our DMS so that we had production coming and cash flow moving forward. But in essence, the overruns are essentially people. So the Pilbara is an expensive place to operate. We required more people there for longer in order to do the same in a job we estimated the year before. It's not unusual. It's unusual for us. We were very disappointed that we had some delays in there. The fact is that I suppose we're buoyed on the other side, the fact that we were able to achieve commercial grade material coming out from day one from the plant. So we really had no doubt that the process plant works. It's a matter of the complexity of some of the tasks or that were at hand, that both the suppliers and the company were not prepared for, or certainly unaware that there was going to be some delays until very, very late in the build. And I think that keys into your question, why do we not raise money earlier? There was no significant need or anything evident at that point in time that was about to happen. So in often these cases, you won't see evidence of when you're going to finish the overrun, or how much that overrun will potentially cost in order to deliver the project. So we pushed on, and we had to do what we did.
And tell me, James, now that you've reached commercial production, the quality of the material is still very much as before, with SC6 and limited impurities. Is that fair to say?
Yes, correct. I think looking at Rodney, the way we had the advanced, completion of our cores through our DNS circuits, certainly provided us with above grade 6%, as we reported. Our iron content well below 1%, and pleasingly for us, one of the most problematic. I think a lot of people get caught up in impurities, but one of the things the converters don't like is mica content. And we've got proprietary property in our classification circuits, but have been very, very effective at removing mica, to the point that our shipments are averaging less than 0.85% mica, and even lower. So that's been very pleasing. So we have no problems. The risk of not producing material that is considered a premium, or at least in line with SC6 guidelines, is removed.
And now that you're on track, can investors expect you to be reaching nameplate or target for Q2?
That's the plan, Rodney. Yes, I think we've exceeded obviously daily and weekly limits to production output to conform with our nameplate of around 18,000 tonnes per month, which equates to roughly around 220,000 tonnes of FC6 annually. We're tracking towards that. I think there's a definite pathway to getting to that point at 100% every day of the week. We've been making some changes as we go through from construction to production, and I think certainly we've been able to, let's say, tap into the existing knowledge pool. Obviously, we've got, I believe, a good working relationship with our neighbours at Pilbara Minerals, and certainly we've had people from our technical suppliers that have been on both sides. We're mining the same ore body, and for all intents and purposes, we've been using great support from DRA and Lenovo, working under the same umbrella company at the moment under DRA. We've engaged Primero more recently. Primero's primary task is to bring in a robust preventative maintenance plan now for operations. Obviously, we're very familiar with lithium and lithium processing, and particularly in Western Australia. So bringing Cameron Henry's team on board has been pleasing, now that they've got some significant items to put their teeth into. Certainly, their on-site presence is certainly valued by the team, and allowing them not only to bring the plan into force, but also they're able to bring in a modification team that allows our existing on-site team to continue with processing material for sale, whereas Primero are able to provide modification support and maintenance support for any other tweaking we need to do to the plant. So, very confident that we're getting out on near those levels in the near future.
That's great to hear. And just from your offtake partner perspective, everything going fine with your various offtakers?
Yeah, at present, we've been able to place all the material that we've been able to produce, and I think Ganfin coming on board on the 8th of November was great for the company. They've been testing the material and processing the material, but the feedback is positive, I believe. They have an option to increase their tonnage in 2019, and we believe that will be taken to a larger number than where we sit at the minimum delivery of 70,000 tonnes per annum. Linergy, our other partner, they've been taking their cargoes as allocated. their plant is not complete to process it internally, but they have got some substantial and let's say validated arrangements for processing material elsewhere in China. So that's been very good. We haven't sold a cargo to J&R Optimum Energy, the other partner, yet. We have reduced their commitment down to 50,000 tonnes in 2019. To be frank, we haven't had a cargo spare to supply, but they're presently not in a position to take that, but we don't see that as being very problematic at this point in time.
Okay, great. And I guess the key question that everyone would like to hear from you, because we have various inputs across the market, but as a supplier of quality material meeting specs in terms of grade and impurities, how are you seeing pricing currently and going forward, say, for the next quarter?
Yeah, it's a good one, Rodney. Most people are keen on working with the pricing trends. There's obviously the impact of having new supply to the market. Tuano, obviously, first in 2018, Pilgrim ourselves almost simultaneously in the latter part of 2018, brings new supply and into the market in both the last quarter of 18 and obviously the first quarter of 19 and onwards. We reported our contracted price average for the December quarter was $722 US on a CFR basis. That seemed pretty normal in the market. We've obviously seen some retrace on that to where we sit. We've got one of our offtake agreements is a formula-based contract with our partners Ganfeng. It's very black and white as to where it delivers, but it's weighted on the pricing of carbonate and hydroxide, so it's fairly easy to track. Outside of that, we're seeing offers, and certainly outside of existing offtake partners, offers in the 600. So I would see it coming from the low to mid 600 US in the coming quarter and beyond. I don't see a continuing decline. I think we've probably hit a bit of a floor, seeing where the market is at the moment. I mean, the price of domestic Chinese carbonate, lithium carbonate, it seems to have plateaued, and I think that's going to be supported by potentially what could be seen as a slightly diminished supply coming out of South America following the rain event in recent months.
Yeah, that's good intel. Thanks. And as you're heading towards reaching your targets in terms of production, and you don't have any interest payments due until the second half of the year, would it be fair to say that you'd be looking at making some fairly decent cash flow in Q2?
I think if we're very much tracking and cognizant the way that I've been brought up in my mining career is looking at costs. There's certain amounts of revenue that we can bother about, and that's purely from a perspective of delivering product that's on spec or above spec specification in regards to pricing. But costs are what drive me personally, most of the groups, so we're monitoring that very closely. Albeit that we announced commercial production last week. The fact is that we've also been mining at a rate which is equivalent to nameplate. Those costs are tracking very, very well against the DFS. Our process costs, excluding some extraordinary items in regards to any minor commissioning costs that are now excluded, are tracking reasonably well. I think there's something we can work on there. And the unit costs in regards to hauling and storing and loading our product on the vessel are a cost per tonne basis, so they're tracking well, and we're pretty confident that once we get sufficient tonnes out, that our costs will be amortised over that tonnage and track very closely to the DFS forecast.
Rodney was mentioning the debt. I think that was originally a 3-year term. Is that correct? And is that something that you might seek to refinance in the coming year? And what about plans for stage 2? What are your thoughts on that?
Yeah, well, probably break it into two parts, but I think they're totally interrelated, Howard. Yeah, the original debt facility was put in place in around August 2017 to allow us to maintain momentum and to build. And we've had our loan note holders being very supportive of us. They're intimately involved in regards to the happenings in the day-to-day operations of where we're at, to remain comfortable that we're meeting our targets. There's no doubt that at that time when we acquired the funding package or completed it, that it was high risk profile, as obviously the lithium market's fairly opaque. It's construction risk. There's obviously project execution risk, ramp up. The fact that we could have the quality that we had was still subjective at that point in time. So we ended up in a high financing situation commensurate to the risk profile that it presents. We have to maintain discussions with our financiers. They're well aware that we would intend to replace that instrument or renegotiate or look at alternatives in regards to bringing that into line now that we've reduced a significant amount of that risk moving forward. So, as I said, they're very well involved in the process, and we certainly we don't want to seem ungrateful, but we need to look at our shareholders and look at something that is more amenable to having a project with sustainable cash flows and margins, as Rodney alluded to before. So, in saying that, Howard, we've gone down a path both with our existing loan note holders and with other parties significantly over the last 6 to 7 months, looking at what type of structures may be in place, what participants we could work with, including the existing loan note holders. But one of the key triggers to that is achieving the production rates that we're at the moment. So that very much unlocks the next stage of processing and trying to include an instrument that we'd hope by the middle of this year would be more amenable to an operation that's got sustainable positive cash flows. So that's the first part of the question. Howard, the second part's in relation to stage 2. Simultaneously while that's going on, we're obviously very cognizant of the need to pin down stage 2 or stage 2 expansion. As I might have said earlier on, Ganfeng do have an option under the existing offtake agreement. They have the rights to 50% of that, the majority coming from stage 2. We don't believe in our recent discussions, we met them the week before last, that right would not be exercised. They're very keen to maintain the diversification of their raw material supplies. How we fund that is probably the discussion that's ongoing between ourselves and Ganfeng. I think if anyone, there's no market secret that Ganfeng are very usually interested in taking equity stakes in companies that have significant offtake arrangements with them. It certainly leaves us with the remaining shortfall of stage 2 to allocate to other parties, and whether the same funding options, we believe that would be the parties we're talking to would be interested in doing the same. As to whether there is any further debt extension or depends on how the makeup of debt to potentially prepayment versus equity balance looks. So that's the part that's really crucial. I think the decision to proceed with stage 2 is more fundamental on the offtake. We'll obviously hit the targets with commercial production. They're quite confident that stage 2, as far as an infrastructure plan and plant works really well for us. So we'll continue on that path, and we'll let's say declutter the stage 2 offtake situation in the coming months.
A couple more questions. Exploration, what your thoughts are on consolidation in the industry, and in particular, potentially, within Western Australia.
Let's do the consolidation first. So I think we've seen that, Howard, and it's probably pertinent you raised it, because it is shown in recent times that there is some alliances being formed. I think particularly one of the things that became very interesting to us as hard rock producers was the investment from traditional brine producers into hard rock, and I think we've seen that in Piedmont. I know Howard did a lot of work with the team at Piedmont SQN coming into that group. You've seen Albemarle now. The transaction with Mineral Resources seems a great deal for parties involved there, and it's certainly looking at the movement towards onshore processing, which is probably another topic. So I think as a whole, there's an opportunity for the right consolidation to work for all parties. I think certainly, we're obviously one of the smaller groups, although the output of the equivalent of 30,000 tonnes LCE is not insignificant in the world market. It's a reasonable chunk, but we're a small entity. In saying that, we're just working on the way we normally do, but I think the stronger groups particularly seem to me are the groups that have access to both brines and they have access to hard rock, and I think we spoke to Rodney earlier, certainly access to participation in the value-adding downstream chain. So I think the deal makers that can put that together, whether it be the companies themselves or external entities to match up people, I don't think we've seen the last of it at this point in time.
The overall region and the exploration upside?
We've got sitting on around 50 million tonnes of resources there, which we've converted roughly around 80% to mineable reserves. We've been looking particularly within the existing mining area, so obviously challenging ourselves to try and garnish the low-hanging fruit, so to speak, for exploration. So we'll continue on in 2019. There's some areas both in the pit itself that need further delineation, and also to immediately south of the pit in the main mining area that really provide us with that bang for a buck exploration. But outside of that, we've got some very attractive tenement packages both to the west and to the north, and also to the east. The east is yielding sort of more significant gold and copper results than lithium. However, we still believe that there's a significant upside potential in the tenement package we do have. And we'll be looking at that as well as we move forward. And I think we discussed previously that exploration costs are pretty high. We've got around 25 years of mine life under stage one, production levels, and around 16 at the moment we're looking at under the reserve base for stage two. So there's a reasonably long mine life there, and I think that's probably pertinent talking in relation to offtake partners. Most of the groups that we are talking to are fairly adamant that we're looking for a longer mine life and longer term offtake agreements. It used to be 3 to 5 years. I think 10 years is going to be the normal, or 10 years to life of mine from our interactions in the last 12 to 18 months. So it is important that we keep that inventory level up in the immediate pit, and it also means that we need to be paying attention to what's outside the area and the potential upside, particularly to the north. So we'll continue on that path. Associated with that, we're always on the lookout for areas that we can acquire. So that process, we've got a team that are dedicated to looking at our exploration upside and our exploration activities, and we'll continue to do so.
And just for Pilgangoora as a whole, do you think it's quite a prospective area?
I think it's getting fairly well delineated, Rodney. I mean, we know, particularly in the mining area in the southern ridge that I was alluding to before, we know there's significant intercepts we've reported previously there. And it's not uncommon to find, 20 to 60 metre intervals in that area. One of the important parts that we're working with our friends at Pilbara Minerals is how we can jointly mine material that would otherwise be sterilised along the boundary. So that's a focus between our two groups. So we have a good working association between the two to make sure we maximise resource recovery for both parties. That's certainly the attractant for that area. To the north, we've certainly at our Altura deposit has yielded some fairly good grade and some fairly significantly thick intercepts that we need to track structurally to see how that fits. And there's no surprise there because it's immediately adjacent to Pilbar's monster pit area. So there's more there, but as I say, we're focused on delivering the key priorities, deliver the project and the project parameters around cost and revenue in order to maintain these programs. But as a group, fundamentally, the board like to put dollars in the ground, and I think that's good for any company. We do not hesitate in regards to exploration programs, but we like to do them and look at risk and reward in regards to how that is going to figure in structurally to add into our inventory annually.
James, if I could just switch gears a little bit and to talk about your capital structure, share ownership. It was very notable that Alan Buckler put in, I think, $15 million into that raise. I don't know him, but what's his background? What's the nature of I understand from you that the share register is relatively tight. And if you could also just speak about your background a little bit, because not everybody who's listening to this podcast has, the familiarity of yourself, relative to some of the other lithium producers out there.
I've got a background in coal mining. That's where I commenced in the mining industry in the early 80s. If you split up the two, probably the areas, the board, particularly Altura, we've had a working relationship and interacted before previously in our other mining lives. So you are seeing the board, which is good, bad or worse. We're mining people, and that's what we know, and we're able to take an approach to every project we look at. We're not here to ramp it and move it on. We're here to mine and operate. That's the way we view each project. I mean, we're quite pragmatic about that. So I started in the early 80s in a little town. I was born in Ipswich, outside of Brisbane, to a family of coal miners. And commenced with a company called New Hope Corporation in Ipswich in 1982, and worked my way through mine planning roles within that company. And the guy that hired me, the person that hired me in 1982 was Alan Buckler, who's now will become our largest shareholder again post the EGM, the positive outcome of the EGM this coming Friday in Perth. So most of the board, we've interacted over a number of years. We've gone our separate ways on occasions and come back, and certainly we've taken an approach that Altura needs to be a company that is in production and is got sustainable cash flows. And I think we demonstrated that with our maintaining our equity we clawed back into the Mount Webber iron ore project in 2009 at a point where the iron ore was becoming extremely topical. So we've always looked at cash flow operations. But as I said, I started in coal and I've had a long history in coal and some other commodities. But certainly Pilbara was born from a board that sat down one evening and looked at all the potential tenements that we had or could acquire over a period of time. And we were focusing on new energy materials, particularly rare earth elements and lithium. And as I said, we sent a team to Pilbara in 2009, picked up a rock chip sample that contained, I think, 5.5% lithium oxide. Within 2 years, we completed a JORC resource in excess of 25 million tonnes, a scoping study in 2013, and mine commencement in 2017. So our approach hasn't changed. Regarding the question of Alan, as I said, we've been working together for a number of years and different commodities, particularly coal. Alan and I worked on some projects, as did most of the board in Indonesia. A period from the later 80s to more recent, to around 2005. And I've lived in Indonesia for 11 years. Over the period of time, so we've come to know each other. Alan's been a big supporter of us as a group and the company as a whole. He believes in the strategy that we're following, and he's always been a quiet supporter of the company. He saw where we needed some funding and looking at some funding, and although he likes to keep a very low profile, he was the first one to say, look, I'll be able to cornerstone this and hopefully that'll make it successful, and that's what's happened.
That sounds great, and it sounds like I think we're going to wrap it up here, but we look very much forward to hopefully some cash flow in Q2 and Q3 now that you seem to have worked out all of the kinks in stage one. So thanks very much, James, and look forward to following your progress.
Thanks, Howard. Thanks, Rodney.
LithiumIonRocks, Lithium-ion Bull, and through our respective LinkedIn and Twitter posts, Rodney and I may share with our audience some rationale for a stock for which we have conviction, to own or not to own. If you agree or disagree with, and that sounds great, and it sounds like I think we're going to wrap it up here, but we look very much forward to hopefully some cash flow in Q2 and Q3 now that you seem to have worked out all of the kinks in stage one. So thanks very much, James, and look forward to following your progress.
Thanks, Howard. Thanks, Rodney.
LithiumIonRocks, Lithium-ion Bull, and through our respective LinkedIn and Twitter posts, Rodney and I may share with our audience some rationale for a stock for which we have conviction, to own or not to own. If you agree or disagree with and act on or against the rationale of anything said or written in this or any other Lithium-ion rocks or Lithium-ion Bull, that's your free choice. But to be clear, what you are listening to or reading is not investment advice and may not be unbiased. It should not be construed as an investment recommendation to buy or sell any security. Rodney and I are not registered investment advisors nor broker-dealers. Please visit libull.com for further disclaimers.